Hey everyone, Nick Carter here, the creator of the most useful trading tools on the planet, and today I'm going to be teaching you guys how I do my technical analysis. Okay, before we get started, I want to let you guys know that this video is not financial advice. I'm not a licensed financial advisor. All the information in this video is for educational, entertainment, informational, and personal opinion purposes only. You are trading at your own risk, and you can lose capital trading. By continuing to watch this video, you do agree to the terms and conditions found at copilot.trade. Okay, so let's start off with what is technical analysis. Technical analysis is reading charts as if they were a story about the buyers and sellers for that underlying asset that you're trading. And what you're trying to do is identify the key levels where traders will be making decisions and where the buyers and the sellers will be coming in to buy or sell the asset so that you can make decisions about where you think the price will go. So first things first, guys, you need to know how to read a price chart. If you already know how to read a price chart, you could skip ahead a little bit here. But basically, in order to know how to read a price chart, you need to know how to read candlesticks and what candlesticks are. You need to know what the base and the quote of the price chart that you're reading are. You need to know that the x-axis on the chart represents the time and the y-axis represents the price. You need to know what pips are. You need to know what the bid price is and what the ask price is, as well as know what the spread on the price is. Okay, so let's start off with candlesticks. I've got some examples over here in the upper right hand corner of what some candlesticks look like. Each candle in the chart represents whatever time frame of chart you're on. So let's say you're on the 30-minute chart. That means each candle would represent 30 minutes. Green candles are when the price closed higher than it started. So let's say the price started at $1 and 30 minutes later it was at $2. That'd be a green candle. And if it started at $2 and went down to $1 after 30 minutes, then the candle would be red. The lines on the tops and the bottoms of the candles are called wicks, and they represent the highs and the lows of those 30 minutes. So let's say this candle, way up here would be the high, and way down there would be the low of that 30-minute period. The body of the candle are these rectangles here in the middle, and these rectangles represent the open and close price. So for red candles, the open price would be the upper part of the rectangle and the closed part would be the lower, and the opposite is true for the green candles. Okay, so next we're going to talk about the base versus quote on the price chart. So the chart shows how many of the quote asset it takes to purchase the base asset. So the base asset is always going to be listed first, and the quote asset is always going to be listed second. So I've got some examples here for us to go over. The first example is GBP/USD, which stands for the Great British Pound/US dollar. So in this example, the British pound is going to be the base pair, and the US dollar is going to be the quote pair. So what this chart would be showing us is how many US dollars it takes to purchase a British pound. In the second example, we've got BTC/USD, which stands for Bitcoin and US dollar. So in this example, Bitcoin is going to be the base pair and US dollar is going to be the quote pair. So what this chart would show us is how many US dollars it takes to purchase one Bitcoin. Okay, so next we're going to talk about pips. So pips are basically a unit of measurement for price movement. And each asset is going to have a different amount of what they consider to be a pip. So for example, a pip on Bitcoin USD is going to be 1 penny. So every time the price goes up or down 1 penny, it goes up or down 1 pip. Whereas on British pound US dollar, 100th of a penny is going to be considered 1 pip. So every time the price difference between British pound US dollar changes by 100th of a penny, that's going to be considered 1 pip for British pound US dollar. Okay, so next we're going to talk about the bid and the ask price. So the bid price is the highest price that buyers in the market are currently willing to pay for an asset. So this is the highest price that you could sell the asset for. Now, the ask price is just the opposite. The ask price is the lowest price that sellers in the market are currently willing to sell the asset for. So that means that the lowest price that you can currently sell the asset for is going to be the ask price. Okay, so let's talk about the spread. The spread is basically the difference between the bid and the ask price. So the trade has to go in the direction that you're trading in by at least the spread in order for you to break even. So of course you want to keep the spreads as small as you can. And when you're choosing your brokers, you definitely want to take a look at their spreads and see who's got the lowest spread, and that ought to influence your decision a little bit. But as an example, so let's say the bid price is $1 for an asset and the ask price is $2. In order for you to break even, when you're buying, it's got to go up by $1, and when you're selling, it's got to go down by $1. Okay, so next up, we're going to talk about the different types of orders that you can submit to your broker. The first type is just a market order, and all a market order is you're just telling your broker, hey, give me the absolute best price that the market has available for me right now. And then there's two more types of orders. There's stop orders and there's limit orders. For a stop order, we'll start with a stop buy. A stop buy is basically saying, hey, if the price goes up to a certain amount, I want to buy. And a sell stop is the opposite. You're basically saying, hey, if the price goes down to a certain amount, I want to sell. And then there's limit orders, and a limit sell, we'll start with that. A limit sell says, hey, if the price goes up to a certain amount, I want to sell it there. And a limit buy is basically saying, hey, if the price goes down to a certain amount, then I want to buy it at that price. Okay, so next up, we're going to talk about indicators. Indicators are basically visual aids that provide some helpful info for you on the chart. All indicators are going to have two different settings. The first is going to be the time frame for the indicator, and the second is going to be the amount of periods for the indicator. So the time frame, this could be daily or 30-minute or 5-minute, and then the periods are the amount of candles that are included in that indicator. So I'll give you an example. I think it's pretty simple once you see an example. If you look at a indicator that has 20 periods and it's on the daily chart, then that indicator would be showing for the last 20 days because you're on the daily chart and you've got 20 periods, so 20 daily candles. And one thing I want to mention about indicators is that you never want to have an overly busy chart. Sometimes you'll see traders that have 1,000 indicators on their chart and you can never see what's going on. Really, you never want to have more than one or two, maybe three at the absolute maximum amount of indicators on your chart at a time. Okay, so now we're going to go over the indicators that I use. The first one is going to be the moving average, and all the moving averages is it's just showing you the average price for the asset that you're looking at. So there's three different moving averages that I use. There's the 20 period moving average, which is going to show you the short-term trend and the short-term average price. There's the 50 period moving average, which is going to show you the medium term information. And then there's the 200 period moving average, which is going to show you more of a long term information. And one thing to know about the moving average is that when it's angled upwards, you're basically in an uptrend. And when it's angled downwards, you're in a downtrend. Okay, so now that you know how to use the moving averages to help you determine the trend, we're going to talk about how to trade the trend once you've determined a trend direction. So for an uptrend, you're going to be looking to buy bounces off the lows. Hey, if you're in an uptrend, the price has dipped down quite a bit and you see it start to bounce up some, that's a good indication that the trend's going to continue and you can go ahead and buy the bounces off the lows. Another thing that you can do is sell the breakouts of the lows. So if you've been in an uptrend for quite a while and you notice that, hey, prices started to dip below where it normally goes and it looks like this trend is over and we're going to be starting a new trend, then you can go ahead and sell the breakouts of the lows in an uptrend. And the opposite is true of downtrends. So if you've determined, based on the moving averages that you're in a downtrend, you can buy the breakouts of the highs. If you've been in a downtrend for a while and you notice that, hey, the trend's starting to reverse, the price has been, going up and has kind of broken out of where the typical highs have been, then you can buy that in anticipation that the downtrend has ended and you're going to be starting a new trend. Another thing that you can do in a downtrend is you can sell bounces off the highs. So if you're in a downtrend, you've looked at the moving averages, you can tell that you're in a downtrend, and the price has reached where the highs have normally lined up, and you can tell that price kind of bounced right off that high and is headed back down. You can go ahead and sell that bounce. Another thing to remember is that the trend is your friend, and you're going to want to always trade with the trend in the direction of the trend, whether that be the continuation of a trend that's already well established, or whether that's once the trend has started to reverse and you can see that a new trend is forming. Either way, you're always going to want to trade with the trend, and you're never going to want to trade against the trend. Okay, so the next indicator that we're going to talk about is Bollinger Bands. Bollinger Bands are probably my favorite indicator. I use them for almost every single trade I make. And what the Bollinger Bands are, it's simply the moving average, and the moving average surrounded by two bands. And these bands are two standard deviations above and two standard deviations below the moving average. Okay, so there are two different trading opportunities that you can look for using the Bollinger Bands. The first one's called the Bollinger Bounce, and what the Bollinger Bounce is when the bands are really far apart, you're likely to see a reversal of the current trend, or at least a pullback on the trend. Hey, if you're in an uptrend and the bands are really, really far apart, you're probably going to see at least a dip, in the uptrend. Price will come down a little bit, or a reversal and start a whole new downtrend. So what you're going to look for, the opportunities that you're looking for with the Bollinger Bounce is you're looking for the bands to be really far apart. And when they're really far apart, you're looking to buy when the price bounces right off the lower band, and you're looking to sell when the price bounces right off the upper band. The other type of opportunity that you can look for using the Bollinger Bands is called the Bollinger Squeeze. And what the Bollinger Squeeze is, it's just like the name implies. It's when the Bollinger Bands are squeezing together, meaning the Bollinger Bands are getting really, really close together, and then the price closes above or below the band. So if the price closes above the upper band, when the bands are really close together and they're squeezing together, that's a buy opportunity. And when the bands are really tight together and the price closes below the lower band, that would be a sell signal. Okay, so the last indicator that I wanted to talk about is called ATR, and ATR stands for Average True Range. And all ATR does is just tell you the average size of a candle. And this is an easy way for you to judge how volatile the asset is. Is it going way up and way down, or just way up over and over every single candle? How volatile is it? Is the price moving a lot on this asset? And this is a really good way to help you determine where you should place your stop losses and take profits and that sort of thing. And when we get to the trade management part of the course, we'll be talking a lot more about ATR and how you can use ATR to help determine where to place your stop losses and take profits and all that kind of stuff. Okay, so the next thing that we're going to talk about is candlestick patterns. There's a million different candlestick patterns, but there's really only two that I use, and I think there's really only two that you need to know. The first is called an engulfing candle. And what an engulfing candle is, there's obviously bullish and bearish engulfing candles. And a bullish engulfing candle is when the current candle's closing price is higher than the previous candle's highest price. And the opposite is true for a bearish engulfing candle. A bearish engulfing candle is when the current candle's closing price is lower than the previous candle's lowest price. The second kind of candlestick pattern that you need to know is called a hammer candle. A bullish hammer candle is when there's a very long wick at the bottom, a very tiny body on the candle, and a very tiny wick on the top, or even no wick on the top, or even no body. And the opposite is true for a bearish hammer candle. A bearish hammer candle is when there's a very long wick at the top, either a tiny body or no body at all, and either a tiny wick or no wick at all. Okay, so that you can visualize what the engulfing candles look like, I've drawn bullish and bearish engulfing candle on my screen here. And as you can see on the bullish one, the closing price right here of the candle closed higher than the previous candle's highest price. And on the bearish engulfing candle, the current candle closed lower than the previous candle's lowest price. Okay, so I've also got some visualizations of the hammer candles here. And as you can see, I've drawn the hammer candles as white instead of green or red because it doesn't necessarily matter if the candles are bullish or bearish, because the body of the candle is going to be so small or non-existent that it's not really going to matter. So on the hammer candle, you can see we've got like a very small body. Body of the candle is very small relative to the entire candle. We've got a very long wick at the bottom, and we've got a small little wick up top. And the opposite is going to be true for the inverse hammer. We've got a huge wick on the top, we've got a very small body, and we've got a very small wick on the bottom. Okay, so the next thing we're going to talk about is very important. Probably one of the most important things, and if you can understand this really well, then you'll probably do really well when you're trading, and that's support and resistance. So support and resistance are basically price levels that we determine are very important. And these important price levels that are below the current price, those are called support levels. And these important price levels that are above the current price are called resistance levels. And the reason that these price levels are very important is because this is where we anticipate that buyers and sellers are going to enter the market and start participating in the market. People are going to come in and start buying assets, or where people are going to come in and start selling the asset. So how you determine where these support and resistance levels are is you essentially just connect the highs and the lows on the chart together to form the support and resistance lines, and we'll look at some examples here in a moment. Um, so these lines that you're drawing on the chart, these support and resistance lines, they form the market structure. And we'll look at lots of examples of different market structure, but for now, just to read off a couple of them to you guys. There's trends, trend lines. We've talked about uptrends and downtrends using the moving averages a little bit, but you can also use trend lines as support and resistance, connecting up the highs and the lows of the trend. There's rectangles, which is basically rectangles, when the price is just bouncing up and down off the same levels over and over. You've got wedges and pennants and triangles and flags and head and shoulders, double tops, double bottoms, triple tops, triple bottoms. Um, and like I said, we'll look at examples of all of these so that you can visualize them and really get a concrete idea of what these different market structures are. And once you have the market structure drawn on the chart, you're going to be looking for a couple of different outcomes that could possibly happen with regard to the market structure. And some of these outcomes are going to be breakouts, which is when, as the name suggests, the price breaks out of the market structure. Say you've got a trend line drawn in an uptrend, and the price breaks out downwards, signifying that the uptrend has ended. That's one example of a breakout. Bounces, let's say, for example, you've got a rectangle drawn on the chart, and the price has just been continually bouncing off the same levels over and over, and you notice that the price has indeed bounced off that same level again. There's going to be fake outs, which is where the price breaks out of the market structure, but only for a moment, just to activate everyone's stop losses, and then completely reverses in the opposite direction. And then there's going to be retests. Uh, and a retest is when the price breaks out of the market structure. Let's say you've got a rectangle drawn, and the resistance price that it continues to bounce off of is $1, and it breaks out of that. Let's say it goes to $1.20, but then it comes back down to retest that dollar price and bounces off that dollar price again. That's an example of a retest, and those are typically some pretty good trades when you can find where the price has broken out of a market structure, gone to retest that price, and bounced again. Um, so yeah, that's the gist of support and resistance. And like I said, support and resistance is going to be very, very important because that's what we're going to use to determine what's the current market structure and where we anticipate buyers and sellers to enter the market. Okay, so before we dive in and look at some examples of market structure and the possible outcomes that could happen when price gets near the support and resistance levels of the market structure, there's a couple of things I want to talk about, and the first of which is confirmation and invalidation. So, confirmation is basically the point at which the possible outcome of the market structure that you've drawn is confirmed. So, what I mean by that, I'll give you an example. Let's say you've drawn up some trend lines on your chart and you're anticipating a bounce. You think price is going to bounce off the support level of the uptrend, as an example, and you're waiting for a confirmation that the bounce is occurring. So what I like to use for confirmation is candlestick patterns. So let's say you're anticipating the bounce off the support of an uptrend line, and you get a bullish engulfing candle right off that support. That would be an excellent example of confirmation. You get that bullish engulfing candle right off the support line, and that would pretty much confirm that the price is bouncing off of that uh, support line. The next thing is going to be invalidation. So, an invalidation is the point at which it's safe to say that you were wrong. So in the same example we used for confirmation, let's say you're anticipating a bounce off of a support trend line, and the price actually does not bounce, and you get a bearish engulfing candle that closes below that support line. That would pretty much invalidate your idea and just prove that, hey, the idea that you thought that was going to happen did not happen. And invalidation levels are a great place to, if you're already in the trade, get out of it, or if you're thinking about taking the trade, don't take the trade. And I always like to have the confirmation and invalidation points in my mind before I go to enter any trades or close any trades or anything like that. Before I go to enter a trade, I'm going to think in my head, hey, has this trade idea been confirmed? Do I have a candlestick pattern that suggests that confirms that my trade idea is most likely going to occur the way that I think it's going to occur. And same thing with validation, excuse me, invalidation. Um, I like to have an idea in my head that, hey, if X, Y, or Z happens, then my trade idea has been invalidated. You've got to be able to admit that you're wrong sometimes, and you've got to have a solid point in your head that you already have when you're in the trade that says, hey, or before you even take the trade, that says, hey, my trade idea has been invalidated. I was wrong. I'm closing the trade. I'm not going to open the trade, whatever it is. So I'm going to be using these terms in the future, and I just wanted to bring them up to you guys so that you understand when I'm saying, hey, this trade idea has been confirmed, or I'm waiting on confirmation, or something like that, or if I'm saying, hey, this trade idea has now been invalidated. I just want you guys to understand what I mean by those terms. Okay, so the last thing that I want to talk about before we dive into some examples is sniper entries versus shotgun entries. And this is a bit of a metaphor. And this is basically a metaphor to describe two different trading styles. So there's the sniper trading style, and the sniper is the person who's always trying to get the absolute best price that they can. Maybe they don't get exactly all the way down to the lowest price before they buy, or the absolute highest before they sell, but they are trying to get as close as possible. They always want to get the absolute best entries and the absolute best exits for their trades. So there's pros and cons to both of these trade styles. With the sniper, obviously you're going to get a better entry and a better exit on your trade, which is great. However, because snipers are always trying to get the best prices, they don't always wait for confirmations before they enter their trades, and they also don't wait for confirmations that it's a good time to exit the trade. Um, So that means that typically snipers are going to have a lower win rate. They're not going to be correct as often, and they're going to have some more losing trades. But the trades that they do enter that are winners are typically going to be bigger winners. And then there's the shotgunner, and the shotgunner is somebody who always waits for confirmations to enter his trade. Typically, his trades he's going to have more confidence in because he has waited for his confirmation, and he's going to have a higher win rate. However, the shotgunner is never going to get, by definition, he's never going to get as good of an entry or as good of an exit as the sniper is going to get because the shotgunner is waiting for that confirmation. So they're just not going to get as good entry and exits, but they're going to have a higher win rate. And whichever style you choose typically has a lot to do with your personality type and your psychology and what kind of mental state that you're in when you're trading. Um, if you're somebody who losses are really discouraging for you, then I would definitely go with the shotgun type just because with the shotgun type of trades where you've waited for confirmation before entering your trades, you are going to have a higher win rate. You're not going to have as many losses. So if losses really hurt your mental state and hurt your confidence a lot, I would go with shotgunning. If you're more into, steady trades where your balance is more steadily increasing, then I would definitely go for the shotgunner type. If you're somebody who has a high risk tolerance and you are the losses don't hurt your confidence that bad because you know that hey, with one really good trade you can make up for a whole lot of bad trades, and you're perfectly okay with that. And the excitement of getting those few good trades that just kill it and go the right way for you and make you a lot more money than your losses lost you, then the sniper entry type is more for you. Okay, so now we're going to get into some examples of the possible outcomes that could occur based on your market structure. So here we've got a rectangle pattern drawn where we keep bouncing off the same lows and the same highs. So those low and high prices that we keep bouncing off of, you just draw a horizontal line between them. And this trader is anticipating a bounce off of this red resistance line, which is the highs that we keep bouncing off of. So this yellow line represents where they anticipate the trade to go. They're anticipating basically a sell-off at this price level right here. So a sniper is as soon as the price gets right close to this red line, or some snipers even wait for it to go a little above this red line, they're looking to sell right then. They're not waiting on any kind of confirmation from candlestick patterns or anything like that. They're ready to just go ahead and take that trade and get the best price they possibly can. Whereas the shotgun trader, he's going to wait for some candlestick confirmations or wait for some price action that indicates that, hey, price has bounced off this line. And then, we've got the invalidation price up here in this area. And when we get to trade management, we'll talk a lot more about, where to place your stop losses and stuff. But I think it's safe to say that, once price gets around in this area, that the bounce trade idea, bouncing off of that red line where the price previously bounced off of several times. If price gets up there to where that arrow is pointing next to the invalidation text, it's pretty safe to say that that trade idea has been invalidated. Okay, so the next example we're going to talk about is a breakout. And so in this example, the market structure is again a rectangle. It's a much tighter range on the rectangle because with breakouts, typically there is going to be a tight range, whereas bounces typically have a large range between the high and the low price of the rectangle, meaning these red and green lines drawn here. And this yellow line again represents what the trader anticipates. They anticipate a bullish breakout, a breakout where the price goes upwards. And so we've got the sniper and shotgun entry and validation prices. So the sniper, he's going to try to buy when the price is way down here close to this green line in anticipation that the price is going to break out of this red line here and continue to go upwards. And the sniper's invalidation level is going to be below the support level of the green line here. Whereas the shotgun, he's going to actually wait until this red line is broken and he gets some confirmation that this rectangle pattern has already been broken, and then his invalidation level is going to be below this red line here. Okay, so now we have the fake out, and again, we've got the market structure of a rectangle. I like using the rectangle for these examples just because the rectangle is the simplest pattern. So basically, the fake out, again, which I talked about earlier, the fake out is when the price breaks out of the market structure, but then just immediately reverses. So this trader is anticipating a fake out, and this yellow line represents the price direction that the trader anticipates. So once the price does break out, the sniper is going to wait until it gets about as high as he possibly thinks it's going to go, and he's going to sell. And his invalidation level is going to be up here above where he entered. And the shotgun entry is the shotgunner is going to wait until it re-enters the market structure, and then his invalidation is going to be above the market structure. Okay, so here we have the retest outcome, and again we have our rectangle drawn where the price is continuously bouncing off the same high price and the same low price until price eventually breaks out of the high price and then goes down and retests the market structure before bouncing upwards. So this yellow line is, the trader who's anticipating a retest outcome is anticipating this yellow line. And so the sniper is going to enter at the very lowest point right here at the red line. So the sniper is going to try to enter as close to this red line as he possibly can. And the shotgun entry is going to wait for some confirmation, of course. So typically that's going to be, either a bullish candlestick pattern or an engulfing candlestick pattern, and they're going to have the same invalidation level, which is going to be below this resistance level. Now, this next outcome here is a less than ideal outcome, and it's basically when there's going to be just no big moves. The price doesn't really move a whole lot in either direction. Um, so let's say, we've got our rectangle drawn here where the price continues to bounce off the same high and low price, and then it breaks out, but it gets back in the pattern, and it breaks out, and it gets back in the pattern, and just continues to repeat that. So this is where you would draw a new market structure, which would just be a small rectangle on these highs and lows, and wait for a breakout of this pattern. And ideally, traders want big moves in one direction or the other. So you really want to avoid when you anticipate these types of outcomes where there's just not really a big move in either direction and not a whole lot's going on, because where traders make money is when the price moves in the direction that they anticipated. So if the price is not really moving in either direction, you're going to want to avoid trading these types of outcomes. And when you do see these occurring, you're going to want to change up your market structure. So I would get rid of the red and green lines that are, currently drawn here, and draw new red and green lines for the new support and resistance that's formed based on these new highs and lows. So all the examples that we've done are rectangles, and I mentioned this briefly during the examples. But when you've got a rectangle that's, basically where the highs and lows are the same repetitively, you keep bouncing off that same low price and that same high price. And when that range between the high price and the low price is very small, you've got a small little rectangle there, you're going to want to anticipate a breakout and trade a breakout. And when that height is very large, there's a very big price difference between those highs and lows. You're going to want to look for bounces because the breakout opportunities are going to be larger when the height is very small on the rectangle, and those bounces are going to provide better opportunities when the height of the rectangle is very large. So here's a great example of a rectangle bounce. We've got a very large range between these highs and lows here, and you're just going to want to look for bounces when the range is so large like this. And here we have an example of the rectangle breakout where, we've got a much smaller range between these highs and lows of the rectangle. And these opportunities are going to be much better trading the breakout than the bounces because when the range is so small, if you're trading the bounce, there's only so much profit to be made between the bounces off of such a small range. Whereas a breakout, you've got a much higher likelihood of getting a trade that just runs in the direction that you anticipate it to run in. Okay, so now we're going to talk about a different market structure, and this market structure is called the wedge. And a wedge is when you have two trend lines that are converging on each other. And we'll look at some examples here in a little bit so you can visualize it. And this works best after a trend has already formed. So you can see that you've been in an uptrend for quite a while, or you've been in a downtrend for quite a while. And there are two types of wedges. One is bullish, you anticipate the price to go up, and one is bearish, you anticipate the price to go down. The bullish pattern is called a falling wedge, and this is exactly what the word falling wedge sounds like. It's when the wedge is angled downwards, meaning that you're getting lower lows and even lower highs. And this works best as either you're continuing an uptrend, so you've been in an uptrend for quite a while, and you see a falling wedge, it means that you're probably about to continue that uptrend for even longer, or you've been in a downtrend for quite a while and you think that you see a falling wedge, and that signifies that the downtrend is about to reverse. And then, of course, we have the rising wedge, which is just the opposite of the falling wedge. And the rising wedge is when you have higher highs, but even higher lows. So the wedge is angled upwards, and this is going to be a bearish pattern, meaning you think the price is going to go down. And this works best either when you see that you've been in a downtrend for quite a while. So you've been in a downtrend for a while and you see a rising wedge. That means that the downtrend is probably going to continue. Or you've been in an uptrend for quite a while and now you see the rising wedge and you think that the uptrend is about to reverse. Okay, so I've got an example of a falling wedge pattern continuation here. So you can see you've been in an uptrend for quite a while, and then you've got this falling wedge confirming, meaning that the wedge is angled downwards. You've got these lower lows and even lower highs. And what you can anticipate when you see something like this is you can anticipate a continuation of the uptrend. Okay, now we have a falling wedge reversal. So as you can see, the price has been in a downtrend for quite a while. And then we get a falling wedge here. The lows are getting lower and the highs are getting even lower. So you see that the wedge is angled downwards. And what you could expect when you see something like this is a reversal of the downtrend and starting a new uptrend. Next up, we got the rising wedge continuation. So as you can see, we've been in a downtrend for quite a while, and we've got this rising wedge forming, meaning the wedge is angled upwards, these two trend lines converging on each other. And what you can anticipate when you see something like this is you can anticipate a continuation of the downtrend. Next up, we've got the rising wedge reversal. So you've been in an uptrend for quite a while, and then you see a rising wedge forming, meaning the wedge is angled upwards. And what you can anticipate when you see something like this is a reversal of the uptrend and the start of a new downtrend. Okay, so the next type of market structure we're going to talk about are triangles. And there are three different types of triangles. There's the symmetrical triangle, the descending triangle, and the ascending triangle. The symmetrical triangle has lower lows and higher lows. So it's two trend lines converging on each other at the same rate. So it's not like a wedge where it's angled upwards or downwards. They're just converging on each other pretty much equally. There is the descending triangle, which is when you have the highs are getting lower, but the lows are staying about the same. So every time price goes up, the high is not quite as high, but every time price goes down, the low price is staying about the same. And then you have an ascending triangle, which is just the opposite of a descending triangle. And an ascending triangle has higher lows and equal highs. So every time that the price goes down, the lows are getting higher, and every time price goes up, the highs are staying about the same. And with triangles, you just want to trade the breakout in either direction. I don't really recommend anticipating one direction or the other with the triangle. And I don't recommend trading bounces or anything like that off of the triangle. I just recommend trading the breakouts with the triangle. And it's more likely to succeed if the pattern forms at the end of a trend. So, you can tell that you're in a well established uptrend or a well established downtrend. Those are going to give you the best opportunities for trading triangles. Okay, so here we've got an example of a symmetrical triangle so that you could visualize what a symmetrical triangle looks like. So we start off, we can see that price has tanked. We're in a pretty significant downtrend here. And then it just starts bouncing off these highs and lows, and the lows are getting higher. This green line's getting higher, and the highs are getting lower. This red line is, sloped downwards. And what you're going to want to do, I've got two yellow lines here. Again, the yellow line is the price that you anticipate. And the reason I have two is because you're just going to want to trade a breakout in either direction. It could be a continuation of the downtrend or a reversal of the downtrend. You're just going to want to be patient and wait for that breakout and trade the breakout. Okay, so the next market structure we're going to talk about is the ascending triangle. And of course, you want to be in a pretty established trend. That'll give you a better chance of succeeding by trading this ascending triangle. And in this example, we're in a pretty strong downtrend before we start this ascending triangle. And an ascending triangle is essentially when the highs continue to bounce off about the same price, and the lows continue to get higher and higher. And when you see an ascending triangle in after a trend has established, you just want to trade the breakouts. Don't try to trade any of these bounces, and don't try to predict the direction that the price is going to break out in. Just make the trade once the price has already broken out. Okay, so the next type of market structure that we're going to talk about is called the pennant. And the pennant is basically when a tiny, very small, little symmetrical triangle forms at the end of a trend. And this signals the continuation of that trend. And you just want to trade only in the breakout of the pennant in the direction of the trend. So we'll look at some examples next. Okay, so now we're going to look at an example of a bearish pennant. And the bearish pennant, first of all, you're going to want to make sure that you are in a downtrend. So the price has been going down and down and down. And then after the downtrend, we've got this symmetrical triangle going on here where, the lows are getting higher and the highs are getting lower at about the same rate. So we've got a symmetrical triangle, and then you're going to want to wait until the price breaks out of that symmetrical triangle. And again, this symmetrical triangle should be very, very small for it to be considered a pennant. It couldn't be like a triangle that's way up here and way down here. It just needs to be a very small symmetrical triangle. It needs to be at the end of a downtrend for it to be a bearish pennant. And you just want to trade the downwards breakout of the bearish pennant. Okay, let's take a look at the bullish pennant. So the bullish pennant is just the opposite of the bearish pennant, which we just went over. So to start off with, you're going to want to make sure that you are in an uptrend. And once you're in an uptrend and you start to see a symmetrical triangle that is very, very small form, and the symmetrical triangle is where the lows are getting higher, the highs are getting lower at approximately the same rate. Once you see that, then you're going to want to trade the breakout of that bullish pennant. So only trade the upwards breakout of the bullish pennant when that occurs. Okay, so the next type of market structure that we're going to talk about are flag patterns. And of course, there's a bull flag and a bear flag. We'll start with the bull flag, which is when you anticipate the price to go up. So a bull flag is going to work the best when it comes after a huge spike in the price has occurred. So the price has risen quickly in the upwards direction, and that's followed by a tiny downtrend. So price shoots way up and then starts a tiny little downtrend. And then what you're going to want to do is buy the upwards breakout of that tiny little downtrend's resistance line. And the opposite is going to be true of a bear flag. A bear flag is when you see a huge spike downwards, and that's followed by a tiny little uptrend. And what you're going to want to do is sell the downwards breakout of the uptrend's support line. Okay, so here we have an example of a bull flag. So the price has spiked upwards. It rose really quickly, really fast. And then we've got like a small little downtrend forming here where the lows are getting lower and the highs are getting lower. And then what we're going to want to do is we're going to want to buy this asset when this resistance line, this red line right here, when the price breaks that line, that's a strong signal that the price is going to continue to move upwards. Okay, here we have an example of a bear flag. So the price fell and went downwards really quickly. And then we have like a small little uptrend form here where the lows are getting higher and the highs are getting higher. And as soon as this green line right here gets broken to the downside, we're going to anticipate that the price is going to continue to move downwards. Okay, so the next market structure that we're going to talk about is the head and shoulders pattern. And I think this one will make a lot more sense to you guys when you see the example and you can visualize it. But I'm going to go ahead and give you guys a description of it. So for starters, the head and shoulders pattern is a reversal pattern that should occur after an uptrend and signify that a new downtrend is going to occur. So the head and shoulders pattern basically consists of the first peak, which is called the shoulder, and then a higher peak than the first peak, which is called the head, and then a peak that is about the same price as the first peak in the price. And what you're going to want to do is connect the valleys between the two peaks. And that line, when you connect up the valley, is called the neckline. And what you're going to want to do is sell a breakout of the neckline. And I know that's a lot to take in, but I'm going to show you guys an example, and I think it'll make a lot more sense when we visualize it. Okay, so here's the example of a head and shoulders pattern so that you guys can visualize it. So we start off, we're in an uptrend here before we even get to this. And then the uptrend peaks out right here, takes a little dip, and then goes on another run to an even higher peak, and then dips back down and makes another peak that's about the same as this first peak over here. And the reason that this is called a head and shoulders pattern is because people call this peak right here the first shoulder, this peak right here the second shoulder, and this peak the head. Just because it looks kind of like, head and shoulders. The shoulders are these two peaks that are even, and then the head is the higher peak. And just so you guys know, there can be multiple peaks in shoulder one and multiple peaks in shoulder two. So it could like bounce around like a little bit right here and create a couple of peaks right here, or a couple of peaks right here, or a couple of peaks at the head. This is just a simple example where there's just one peak on each. But if there's two peaks on this shoulder, or two peaks at the head, or whatever, it's still a head and shoulders pattern. But what you're looking for is one peak or multiple peaks at the two shoulders and the head. And how you're going to want to trade this pattern, which this is a great pattern, by the way, it really gives you a lot of great signals, is this green line here is called the neckline. And how you draw the neckline is these two valleys right here, this valley and this valley. You just draw a line that connects those two valleys. And how you can find these two valleys is the valleys will be in between the heads and the shoulders. So you see the head and shoulders pattern, price breaks downwards below the neckline, that's when you're going to want to sell. Okay, so there's also the inverse head and shoulders pattern, and the inverse head and shoulders pattern, just like the name suggests, is just the opposite of a head and shoulders pattern. So if you just take the pattern that we just looked at and you flip it upside down, that would be the inverse head and shoulders pattern. So the head and the shoulders of the inverse head and shoulders pattern is going to be the valleys instead of the peaks, and the neckline is going to be the peaks instead of the valleys. And what you're going to want to do is you're going to want to buy on a breakout of the neckline, and we'll look at an example next. Okay, so here's the example of the inverse head and shoulders pattern, and this pattern's going to work the best if you're already in a downtrend when you see this pattern. So in this example, we're in a downtrend, and we get this valley right here, which is going to be the first shoulder, and then we get a little bounce upwards, but then it just tanks down even farther. And this valley right here is going to be the head, and then price bounces back upwards, and peaks out right here, and then comes back down to the second shoulder, which is this valley right here. And then what we're going to want to do is draw the neckline, which is going to be these two peaks right here. And as soon as the price breaks that neckline and it breaks it upwards, we're going to anticipate bullish price action. We're going to anticipate that the price is going to go up, and that's our signal to buy. Okay, so the next type of market structure that we're going to discuss is called the double top. And the double top works best at the top of an uptrend. So if you're already in the uptrend and you see a double top, that's going to be the best time to take a double top. What the double top is basically when there are two tops, two peaks in price that are very close to the same price with a valley in between them. And what you're going to want to do when you see a double top at the end of an uptrend is you're going to want to sell when the price goes below the valley between the two tops. And we'll take a look at an example next. Okay, so the next type of market structure that we're going to discuss is called the double top. And the double top works best at the top of an uptrend. So if you're already in the uptrend and you see a double top, that's going to be the best time to take a double top. What the double top is basically when there are two tops, two peaks in price that are very close to the same price with a valley in between them. And what you're going to want to do when you see a double top at the end of an uptrend is you're going to want to sell when the price goes below the valley between the two tops. And we'll take a look at an example next. Okay, so here's an example of a double top. And remember, we're already in an uptrend before we see this. But essentially, we've got one peak right here after the uptrend. Price dips down a little bit and comes back up and peaks out pretty much exactly the same price, almost exactly the same price, right around that peak that we had earlier. And then price tanks right after that. And when you're going to want to sell is going to be when this valley right here gets broken. So we're in an uptrend, we peak out, we dip back down, we come back up to almost the same price that we were at before. And then after you see this valley between the two peaks here gets broken, that's when it's time to sell the double top. Okay, so let's talk about the double bottom. The double bottom is just the opposite of a double top. The double bottom is going to work best when you're at the bottom of a downtrend. So you've been in a downtrend for a while and you see a double bottom, that's going to be the best time to take a double bottom trade. The double bottoms come close to the same price with a peak in between. And you're going to want to buy when the price goes above the peak between the two bottoms, and we'll look at an example of this next. Okay, so next we're going to look at this double bottom pattern here. Again, this pattern works best when we're in a downtrend, so we're going to want to make sure we're in a downtrend before we take any double bottom trades to give us the highest likelihood of success. So we're in a downtrend and price bottoms out here, pops back up to this little peak, and comes back down to about the same price as the initial valley that we had right here. And what you're going to want to do with the double bottom is you're going to want to take the buy trade when this peak right here gets broken. Okay, so next we're going to talk about the triple top. The triple top is pretty much the same thing as the double top, except there are three tops. So just like the double top, it's going to work best if you're already in an uptrend when you see a triple top. And these three tops need to be at about the same price, with two valleys that are also at about the same price in between the two tops. And what you're going to want to do is you're going to want to sell when the price goes below the valleys that are between the three tops. And we'll look at an example next. So next we'll go over the triple bottom, which is just the opposite of a triple top. This one's going to work best when you're at the bottom of a downtrend. So you've got an established downtrend before you see the triple bottom. That'll give you the highest chance of success with the trade. And basically, there are three bottoms that are close to the same price with peaks that are in between, and those peaks are also at about the same price. What you're going to want to do with a triple bottom is you're going to want to buy when the price goes above the peaks that are between the three bottoms. And we will look at an example of this next. Okay, so here is the example of the triple bottom. Of course, we're already in a downtrend before we see this pattern in order to give us a higher chance of success. So we're in the downtrend, price bottoms out, bounces up, and then goes back down to about where we initially bottomed out from the downtrend, bounces back up to about the same where we just peaked out a little bit earlier, and then price goes back down for a third low that lines up with the previous two lows. And what you're going to want to do is buy on the breakout of these two highs. Okay, so that's it for the different market structures, and next we're going to talk about confluence. And confluence is basically when things are in agreement with each other. So the more things that you have that agree that the price is going to go in one direction, the better chance of success that you have for that trade. So some things that could be in agreement or disagreement with each other would be things like the support and resistance levels that comes up with the market structure, the candlestick patterns, the hammer candles and the engulfing candles, and also things like the Bollinger Bands. Are the Bollinger Bands really tight, signifying a breakout? Are they very far apart, signifying a bounce? What do the moving averages say? Are they, all pointing towards that the trend is in the direction of the trade that you're trying to take? You're going to want to look at a lot of different aspects of your trade, and the more aspects that are in agreement with each other, the more confluence you have. The more confluence you have, the better success rate you're probably going to have with that trade. Okay, so let's talk about risk management. So once you're in some trades, and before you enter the trades, what can you do to help manage your risk and increase your risk to reward ratio? So speaking of risk to reward ratio, let's talk about that first. Really, I don't recommend taking any trades that are less than a 3 risk to reward ratio, meaning that, hey, if your stop loss gets hit and you're going to exit the trade at a certain price, and you're going to lose $1 if you exit that trade at that price, you better make at least $3 if the trade goes your way. So your reward should always be at least 3 times your risk, preferably even more than that. Another thing that you can do is scale in and scale out of your trades. And what I mean by scale in and scale out is instead of entering the entire trade at once and closing the entire trade at once, you can enter a little bit of a time and exit a little bit at a time. So instead of entering all in, the very first entry you take, just enter, a fifth of the amount that you plan on entering. And then if you see, if the trade continues to look better, enter another fifth and another fifth and another fifth, so that you're scaling into your trade. And then same thing with scaling out. Instead of exiting the whole trade all at one time, you can exit a little bit of the trade and then exit a little bit more, a little bit more, a little bit more. So that'll help mitigate your risk. Another thing that you can do is have a break-even price, and what a break-even price is basically when the price goes to a certain level. What you're going to want to do is move your stop loss to to break even, so that you're risk-free on that trade. Once your stop loss is moved to your break-even price or above, you have zero risk. The worst thing that could happen is that you break even on the trade. Some other things that you can do are trailing stop losses. And what a trailing stop loss is as the price continues to go in the direction of your trade, your stop loss is going to follow along with it. So let's say you're in a buy order. As the price moves up, your stop loss moves up too. You can also do self-tightening stop losses. So as the trade gets farther and farther and farther into profit, your stop loss is not only following along as the price goes up, but it's getting closer and closer and closer, so that you're locking in even more profit as the trade goes in your direction. You can also do candle trailing stop losses, where essentially you move your stop loss a certain distance below the previous candle. Um, Another thing that's very, very important, and I can't stress this enough, is cut your losses short and let your winners run. And what I mean by that is, once you can tell, hey, this trade's not going my way, my invalidation level has been reached. Go ahead and cut the loss on the trade. Don't be afraid to take a small loss before it turns into a big loss, and let your winners run. Hey, if you got a trade that's going your way, and it looks like it might be able to really go your way, hey, let it run, let it take its course, and let it go as far as you think it can go. Don't just, hey, I'm a little bit in profit, let me take this tiny little bit of profit and run. No, you want to let your winners run. You want to let your winning trades go as far into profit as they can, and you want to take your losing trades and cut them short. So stop losses and where to place your stop loss. There's a couple of different ways you can do it, and you can do combinations of these as well. Um, One is going to be candlestick patterns. So let's say you entered a trade based on a bullish engulfing pattern on top of support. What you could do is you could put your stop loss just below that bullish engulfing pattern, because that bullish engulfing candle is going to be a level of invalidation for you. Hey, if it goes below that bullish engulfing candle, you probably weren't right about the trade. The trade was probably wrong. So that's a good place to put your stop loss. You can also use market structure. Hey, let's say you traded a falling wedge. You could put your stop loss just below that falling wedge. And like I talked about much earlier in the course, using the indicator ATR, which, just to refresh your mind, ATR stands for average true range, and it basically gives you the average size of a candle. And you can use that average size of a candle to help you determine where to put your stop loss. For instance, let's say again you traded a buy order on a falling wedge. You could put your stop loss 1 ATR below that falling wedge. So one candle below the falling wedge. That way, if it just dips down a little bit below it, it won't get hit. But if it goes the size of an average candle below it, that's pretty good indication that it's time to get out of that trade. So I use ATR to help me place all of my stop losses. I really like to use the average candle size to determine, hey, I want to put it 1 to 2. Typically 3 would be like the absolute max, but really 1 to 2 candles below either a candlestick pattern or the market structure that helped me enter the trade. So as far as taking profits go, and when when you're in profit and you're ready to cash out, you can determine where to put your take profit orders based on, again, the market structure and ATR. So those are two different ways you could do it. I typically like to do between 4 and 6 ATR in profit is where I'll be taking the money and cashing out of the trade. You can also use the size of the market structure. So let's say you're trading a bounce off of a really big rectangle. Well, you can look at the size of that rectangle and basically take profits right before you hit the resistance of the rectangle. So you can use the size of the market structure. Same thing works for wedges and things like that, to where take the widest part of the wedge and measure that distance, and that's typically a really good distance that you can use for taking profits. Another thing that you're going to want to consider is this is an old saying in trading, and the saying goes, "Buy the rumor, sell the news." And what I mean by that is, Let's take uh, let's take an example where some really bullish news is going to come out. So let's say there's a rumor that a stock that you're trading is going to have, some kind of feature. Let's say it's a software stock, and they're going to come out with a feature that's going to get them a whole lot more users. And there's a rumor that this feature is coming out. When the news actually does come out, when they launch that feature for that software company, or whatever the positive news that comes out is, typically that's when you're going to see the price tank. So buy the rumor, sell the news. Whatever the rumor is much more valuable than when the news actually comes out, because the people who are in the know, the people who know more than the public, they know the rumor. The public knows the news, and you want to be on the side of the people who are in the know, not the people who are in the public. So buy the rumor, sell the news. That's just a little tip for you. And don't be afraid to reverse the direction of your trade. If the setup is bi-directional, take triangles as an example. So let's say you're in a trade. Let's say it's a symmetrical triangle, and you bought the breakout of the symmetrical triangle, but then the breakout ended up being a fake out, and the price tanks on you while you're in a buy trade. Don't be afraid to close that buy trade and open up a sell trade. If your invalidation price has got hit and you're pretty confident that price is going the opposite direction, go ahead and reverse the trade. Okay, so next we're going to talk about the different time frames that you can trade on and how to handle these different time frames. So the first time frame is going to be the 1 to 5 minute chart, and people who look at these small, tiny time frames where each candle is just 1 minute or 5 minutes, they're called scalpers, and it's called scalping the chart when you're looking at these tiny time frames, and you're just trying to scalp off just a little tiny profit off of a whole lot of trades. And scalping, typically you're going to take really, really big trade sizes using a lot of leverage. And you're still gonna keep a very tight stop loss though, so that even though your trade size is very large relative to your account, because your stop loss is so small, if your stop loss gets hit, it's still not going to be very risky. So large trade sizes, lots of leverage, and small time frames. That's basically the gist of scalping. You're going to want to take about a 0.5% to 2% risk on every trade. 0.5% would be on the conservative side, 2% would be on the risky side if you're a scalper. And with scalping, you're going to have to pay very close attention to the charts. You're not going to want to, take your eye off the chart while you're scalping. You're going to want to be focused in on the charts. So day trading is basically when you're in and out of a trade at the same during the same day. And typically, day traders look at the 15-minute to the 4-hour chart. They're going to take large trade sizes as well, not nearly as large as the scalpers are going to take, but they're still going to take large trade sizes. They're typically going to use a medium amount of leverage, not as much leverage as the scalpers. They are going to have tight stop losses, just like the scalpers, but again, not nearly as tight as the scalpers are going to have. They're going to have pretty large risk to reward ratios when you're day trading. And the risk, I recommend about the same amount of risk per trade as scalpers, a 0.5% to 2% of your account. And if you're day trading, you're going to need to check the charts at least once or twice every hour, preferably, a little more than that, maybe every, 15 to 30 minutes. That's about how often you're going to want to check the charts if you're day trading. If you're swing trading, which is my personal favorite, I love swing trading. The trades for swing trades last between a few days to a few months. Typically, though, a few months would be a really long swing trade. My swing trades typically last anywhere from 3 days to 3 weeks. And swing traders normally look at the 4-hour chart to the weekly chart. They take medium trade sizes, so nothing crazy, no tons of leverage or anything like that. Um, the risk to reward ratio is about medium compared to scalping and day trading. The stop loss is the same. Your stop losses are going to be farther away when you're swing trading than if you're day trading or scalping. And you can take a little bit more risk on the swing trade. 1 to 3.5%. I would say maybe even up to 5% if you're like very very confident on the trade. And the reason being is because you're going to take a lot less trades as a swing trader. So, if you're someone who's scalping and you're taking, 3, 4, 5, 6 trades a day, um, then if even if you're only risking 0.5% a day, that if you have one bad day where you lose 6 trades, you could be down 3% on the day. Whereas if you're swing trading and you're holding it for at least a few days, you can risk a little bit more per trade without overall being more risky because you're not taking as many trades. And with swing trading, you really only need to check the chart maybe once to twice a day. You know, at the start, at the beginning of the day, or even just at the end of the day would be okay. And then there's investing, which I would say is like over 6 months. So anything over 6 months, you're pretty much just investing in that. And really, with investing, you don't really use too much technical analysis. You don't really use stop losses if you're investing and you just plan on holding this thing for a very very long time. You're more about the long-term vision of the underlying asset, and you're relying more on the fundamental information about the asset, not so much on the technical analysis. And one thing that I would highly recommend to you guys, and this has worked really well for me, is what you can do is you can draw your support and resistance lines in your market structure on higher time frames and use smaller time frames to enter and manage your trade. So, as an example, let's say you're swing trading and you're looking at the daily chart or the weekly chart. And you notice that, hey, right now the price is sitting on support for the daily and the weekly chart. Then you could zoom into the 4 hour or even the 1 hour or 30 minute, and you could, once you're zoomed in, you could get a better idea of what's going on right now. And you can basically use the overarching idea that, hey, we're sitting on a daily or weekly support, and then you use a lower time frame to actually determine your entries and also your trade management. Okay, so now we're going to talk about some different trading styles that you can utilize. The first of which is called a trend follower. And trend followers, they just find a trend that's already established, preferably early in the trend, and they just ride that wave. If it's an uptrend that's, recently started, they'll just buy on a dip and just ride that wave until, the trend ends. There's also the counter trend trader. And a counter trend trader is basically someone who is trying to find when the trend has finally reversed and a new trend is starting. Then we've got a momentum trader. Momentum traders typically look for really big breakout buys or sells off of rectangles. And typically, momentum traders, they're looking for that big spike up or spike down in price. We also have range traders. Range traders look for basically assets that are typically bouncing off of the same lows and the same highs. They buy the lows, sell the highs. You also have asset and asset class specialist. These are people who just focus in on one asset or one asset class and get really in tune with the price action that's going on in that asset or that asset class. And then you also have market structure specialists that they just have one market structure that they look for across lots of different assets and asset classes. Could be a wedge or a triangle or something like that, but they get really good at trading one specific pattern and look for that pattern across different assets and asset classes. Okay, so next up, we're going to talk about trading psychology. Um, so basically, you want to create a rule set for yourself and you want to follow those rules like a robot, meaning you have no emotion. You want to be emotionally detached and don't let your emotions decide your trades, but more so your rules that you've set for yourself decide when you enter and exit trades. Um, so when it comes to emotions, one of the things that kills traders a lot is fear. And there's a lot of different ways that fear can hurt you, one of which is FOMO, which stands for fear of missing out. So FOMO, fear of missing out, is basically, let's say, out of nowhere, the price spikes up tremendously on some asset, and you're like, oh man, I should go ahead and enter this trade because the price is just going up and everyone's getting in on it. And typically, you want to enter trades before that price spikes. And typically, after the price has spiked, the people who bought before the price spike are going to sell, and they're going to sell to you, and you're going to lose. So you want to avoid fear of missing out. Also, I'm sure a lot of you have heard the saying "scared money don't make money," and basically, if you're so afraid of losing that you can't enter trades when all of your rules are met and the opportunity is there, you're not going to be able to make good trades because you're scared to enter trades when all of your rules are met and the opportunity is there. Another thing that fear will destroy traders on is admitting when they're wrong. So a lot of times, when the trade's not going your way, and your rules say that the trade has been invalidated, a lot of traders are afraid to admit that they're wrong and just go ahead and take that small loss, and they'll let that small loss turn into a big loss. Another emotion that kills traders is greed. So a lot of traders, they'll make an excellent trade and they'll be way in profits, but they won't close their trade because they get greedy. They think that it'll infinitely go in the direction that their trade is in, and they just won't take profits and they'll just leave the trade open until eventually the trade goes against them and they're either losing money or they've lost a ton of the profits that they've gained. Another thing to keep in mind is you just want to be completely detached from the trade outcome. And a way that you can be detached from the outcome of the trade is only trading what you're willing to lose. So, if you've got $100,000 account and, you're in a trade that if your stop loss gets hit, you're only going to lose 200 bucks. You're not going to really be attached to that trade and you're not going to be emotionally involved in hoping that the trade goes your way. You're just you're following the rules, and hey, if the trade doesn't go your way, it's perfectly fine. So you want to trade sizes that you're comfortable with if the trade doesn't go your way, and that'll allow you to be detached from your trades. Another thing is patience is a virtue. So you're going to want to wait until all of your rule sets have been met and you've got confirmation and you're confident in the trade. Don't be antsy to pull the trigger on trades. Let the trade come to you. um, you're going to want to pick trading styles and trading time frames that fit your psychology. So if you're somebody who if you got like ADHD or ADD or something like that, and you're hyper focused on the charts, and you get bored waiting for trades to go your way over long periods of time. Maybe you're a scalper, or if you're somebody who you just want to put a trade on and relax and just check the trade maybe once a day or something like that. You're probably going to be more of a swing trader or a long-term investor. So you're going to want to pick trading styles and trading time frames that fit your psychology, because if you don't, then your emotions are going to be all over the place. You're always going to want to have an objective basis on your trades and never have biases. So let's say you're a big fan of Tesla and you love Tesla cars, and Elon Musk is your hero and everything. Even if that's the case, when you're trading Tesla stocks, you're going to want to be completely objective. You're not going to want to let those emotions affect your decision making. So even if you're a huge fan of the underlying asset, just be objective with the trade. Another thing that I highly recommend to everyone is a book called Trading in the Zone. Probably the best book that I've ever read on trading psychology, and you can listen to it for free on YouTube. Okay, so the last thing that I want to talk to you guys about is how to automate all of the things that you've learned in this video. So I've created software that will allow you to do that, called Copilot. And basically, again, everything that you learned in this course, you can automate the vast majority of it so that trading is not nearly as time consuming for you. So, Copilot allows you to essentially just draw your support and resistance lines on the chart in order to establish the market structure. And then you just decide what outcome that you anticipate with regards to the market structure, whether that be breakouts or bounces or retests or fake outs or whatever the case is. You can automatically enter trades based on the candlestick patterns we learned about, like engulfing candles and hammer candles. You can scale in and scale out of your trades automatically. All of the trade management tactics that we discussed, you can automate that. And also with automation, it allows you to take human emotions out of the equation, because, like we talked about earlier, you want to trade like a robot and just follow your rule sets. So why not just utilize a robot to do so? We also have trading signals that come for free with Copilot. And trading signals are basically where I do a lot of the work for you guys with regards to determining what the market structure is, drawing the support and resistance lines, determining trade management settings and all that kind of stuff. All of these trade signals you do have to implement at your own discretion. So, like I said at the beginning of the video, I'm not a financial advisor or anything like that. I just basically scan the charts, help you guys pick out the market structure, and tell you guys what I see in the charts. And it's just a personal opinion of mine. And you can try all of this for free. Just give it a try for a couple of weeks and see how you like it. Just go to copilot.trade.com and click on the free trial, fill out the form, and give it a try.